Have you ever had that feeling, where you're trying to understand how a company is doing? Like you're wading through these massive reports, tons of text, tables, and numbers, maybe a chart or two thrown in. It's like trying to see the whole picture through this tiny little keyhole.
Oh, absolutely. The sheer amount of information in finance is overwhelming. And it's all connected, right? What the text says is crucial for understanding the numbers and the visuals. Well, they try to sum up all the complex trends. But traditional analysis, it often falls short. It struggles to really put all those pieces together and pull out the truly deep insights, the ones that can really make a difference.
And that's where these things called LLMs come in, right? Large language models. They sound like some powerful new tools, like something out of science fiction almost. Processing all that complexity, understanding it at a speed and depth we just haven't seen before.
They really are remarkable. These LLMs, they understand natural language, they get the context, they even reason in a way. And the speed of their development, it's been incredible. But the financial world, well, it tends to be cautious, not jumping in head first, which makes sense when you're dealing with people's money.
Yeah, a measured approach is definitely wise. And that's exactly why we're doing this deep dive today. We want to understand how LLMs are actually being used in finance right now. What are the strategies? What kind of results are they seeing? And what are the limitations? What are the potential downsides? Because our sources, they paint a really detailed picture of the current research and how it applies to the financial world.
We want to break it down for you, explain the logic, the why behind these strategies, give you a balanced view, both the exciting potential and the very real things you need to consider. Because finance, it's a critical field. It impacts all of us.
Absolutely. So let's jump right in.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
One of the main things these LLMs are being used for is analyzing financial text. And just think about it. Company reports, news articles, social media, there's so much crucial information buried in all that text. But traditional methods, they just scratch the surface, right?
That's the problem. LLMs are different. They understand the nuances, the sentiment, the subtle relationships between different pieces of information. They go way beyond simple keyword searches.
And that leads to some pretty interesting applications. Our sources point to 4 key areas where LLMs are making a difference. The first one is text classification, basically putting financial texts into different categories.
Right, and one big part of that is sentiment analysis. That's where the LLM reads, say, a news article or a company report and figures out the overall tone. Is it positive, negative, neutral? This can actually give you an idea of how the market might move, a sort of early warning system.
So is it like reading the room, but for the entire financial world? Do they actually do a good job of capturing that sentiment?
They're getting pretty good at it, actually, picking up on subtleties that traditional methods miss. And this sentiment analysis, it's being used for financial prediction, too. Trying to forecast things like, will stock prices go up or down? Will there be some big corporate event like a merger? And the evaluations, using things like accuracy and the F1 score, they're showing some promising results. So instead of just counting positive or negative words, it's about really understanding the underlying feeling. That gives you a much more nuanced view of what might happen in the market.
That makes sense. Not just counting words, but really getting the vibe, so to speak. The second application is information extraction. Sounds like trying to pull out specific data from all that unstructured text.
Exactly. There are 2 main techniques they use. First, there's named entity recognition, or NER. This is about identifying the key players in a document, company names, currencies, important numbers, dates, things like that. And then there's relation extraction, which goes a step further. It figures out the connections between these entities, like Goldman Sachs downgraded Tesla because of something specific. Imagine you're going through pages and pages of reports, and bam, you instantly see not just the numbers, but how they all fit together. That's the power of LLMs.
So it's not just finding the data points, but understanding the whole story, the narrative behind them.
Right. This is a huge help for analysts who are trying to understand what's happening, what it all means, and the evaluations, using things like precision, recall, and the F1 score, they show that LLMs are really good at this. They can process those complex documents and pull out those insights much faster than we ever could.
That's impressive. Okay, the third one is text summarization. Now, we've all seen those giant earnings reports or those long, complicated regulatory filings. Having an LLM that can condense those down to the essentials, that would be a lifesaver.
Wouldn't it? The idea is that the LLM reads the whole thing and creates a shorter version, a summary, but without losing any of the key information. A huge time saver for analysts and investors. And there are ways to measure how good these summaries are. They use things like ROGE and BLEU scores. They basically compare the LLM summary to one written by a human, looking at how much they overlap, both in terms of content and even the words used.
So it's not just randomly picking out sentences, it's actually trying to understand what the document is really saying. And finally, there's question answering. This sounds amazing. Like you ask the LLM a specific financial question and it gives you a relevant, insightful answer.
That's the goal. The LLM uses its knowledge of financial concepts. It even does calculations if it needs to. And what's really interesting is that they're starting to combine different types of data. Like you have the numbers from a financial statement, and then you have the explanations from, say, the management's discussion and analysis. So you could ask something like, why are this company's expenses going up? And the LLM would look at both the numbers and the explanations to give you a comprehensive answer. And to evaluate this, they look at things like exact match, which means did the LM give the exact right answer? And also, is the answer factually correct?
Wow. It's really starting to feel like they're not just understanding language, but actually thinking and reasoning with financial information. Now, let's move on to some specific areas within finance where LLMs are making an impact. Trading, for example, seems like a natural fit.
It is. And within trading, we're seeing some really sophisticated uses of LLMs for sentiment analysis to predict stock prices. But this goes way beyond simply labeling something positive or negative. They use things like chain of thought, which is where the model actually explains its reasoning step by step, almost like showing its work. And then there's retrieval augmented generation, where the LM can access and use relevant outside information in real time. Some models even use historical market data as a kind of memory. And there's even research into using multi-agent systems, where multiple LLMs actually debate each other about potential trades, which helps to refine the predictions. They're even exploring things like reinforcement learning to further optimize these predictive capabilities. It's a whole new level of sophistication.
So it's like having a team of expert analysts, all powered by AI, constantly crunching data and arguing with each other to come up with the best trading signals. That sounds intense. And how's it working out in practice? What kind of results are they seeing with this advanced sentiment analysis in trading?
The results are pretty encouraging. First, there's the explainability factor. We can actually understand why the model made a certain prediction, which is crucial in finance. You don't want to just blindly follow a black box. And the predictions themselves, they're becoming more precise. So you have more confidence in the analysis.
Yeah, the why is just as important as the what when it comes to finance. Now, what about using LLMs for time series analysis and trading? That's always been the domain of those really complex statistical models, hasn't it?
It has. But here again, LLMs are proving to be surprisingly capable. They're being used to integrate both textual and numerical data to forecast stock prices and manage portfolios. Imagine asking an LLM to analyze, say, 50 years of market data alongside all the news and events that happened during that time. You might start to see patterns that traditional statistical models would miss. And we're actually seeing this happen. There are models that can combine text and time series data across different historical periods. They can identify potential breakouts in the market and even use things like chart images along with text queries to make predictions. And what's really interesting is the human-AI collaboration aspect. Financial experts, they use clever prompting to guide the LLM, which helps uncover those hidden patterns.
So it's like having this incredibly knowledgeable AI assistant who can not only analyze the numbers, but also understand the context, the historical events, and even learn from human experts. What kind of results are they seeing with this approach?
The results are quite promising. They're able to find those non-obvious patterns, make forecasts across different time frames, and provide those much-needed explanations. Some research even suggests that LLMs are starting to outperform traditional methods, like reinforcement learning in certain areas of trading. They can even tailor investment advice based on an individual's goals and risk tolerance.
Wow, that's a real game changer. And it's not just about predicting prices, right? LLMs are also being used for fundamental analysis, which is all about understanding a company's true value.
You're right. Traditional language models struggle with this because fundamental analysis requires deep reasoning and understanding of the context. But LLMs With their massive knowledge base and their ability to reason, they're changing that. Techniques like retrieval-augmented generation help them efficiently process all the relevant company filings and research reports. We're seeing them used to categorize companies, to quantify how complex a business is, even to simulate how managers might react in different situations based on their past behavior. They can even evaluate the potential impact of a company's policies.
So they're not just crunching numbers, they're actually trying to understand the company, the management, the whole picture. How does this help someone who's trying to figure out a company's real worth?
The biggest advantage is that they can combine the qualitative information, the stories and the context, with the quantitative data. That's always been a challenge in fundamental analysis, and this leads to more accurate valuations, a better understanding of how different companies are related, and just more comprehensive support for investors.
It really feels like LLMs are touching every part of finance. What about financial risk modeling? That's another area where understanding complex information is essential.
Absolutely. LLMs are being used to analyze all sorts of data, corporate disclosures, earnings call transcripts, market data to predict things like bankruptcy, fraud, to do credit scoring, and even assess those broader systemic risks. Some models are even creating these things called knowledge graphs. They're like interconnected networks of information that help you understand the relationships between different entities and risks. And there's some cutting-edge research happening with multidimensional analysis. That's where they combine text, voice data from calls, and even graphs to get a more complete picture of the risks. They're also using LLMs to understand the cause and effect of risks, like how might one company's problems spread to others, and even how things like tax audits can change how companies act.
So it's not just about predicting if something bad might happen, but also why it might happen and how it could affect everything else.
Right. And this leads to more accurate risk assessments, which could make the whole financial system more stable and resilient.
Okay, let's step back for a minute and talk about the theory behind all of this. Why are LLMs so good at these tasks? What makes them work so well?
It comes down to a few key things. First, they can process massive amounts of information from all different sources. They can read and understand text, and they're getting better at other types of data too, at a scale we humans just can't match. Second, they're really good at understanding the context, even in those super long documents. They can follow the story and pick up on all the little cues. Third, they can actually reason, especially when you use techniques like chain of thought, which helps them break down complex problems into smaller steps. And then there are prompting techniques, things like zero-shot learning, where they can do tasks they weren't specifically trained for just based on the instructions you give them, and in-context learning, where you give them a few examples and they learn from those. And all of this is built on something called the transformer architecture. There's a really innovative way of designing neural networks.
So it's this combination of data processing power, understanding context, reasoning ability, and flexibility that makes them so powerful, right?
Exactly. And it's important to remember that this is a very interdisciplinary field. It combines the theoretical side of finance and economics with the practical side of computer science. You need both the AI expertise and the financial expertise to really make this work.
You need people who understand both the technology and the money. Now, even with all this potential, there are some significant downsides to using LLMs in finance. Our sources highlight some things we really need to be aware of. The first one is hallucinations. That doesn't sound good at all when we're talking about finance.
No, it's a serious issue. Hallucinations are basically when the LLM generates something that's just plain wrong. It could be a factual error, like saying a company earned a certain amount when they didn't, or it could be a flaw in the reasoning. And this wrong information, it can spread and lead to bad decisions. That's why people are being cautious about using LLMs in finance. They don't want to risk making big mistakes. And while techniques like RAG and COTI can help by grounding the LLM's responses in real data and making the reasoning more transparent, they're not foolproof, especially when you're dealing with very specific areas of finance or really complex reasoning that involves multiple sources.
So the AI might sound very confident, but it could be completely wrong, and that could have serious consequences. Another issue is mathematical reasoning. Finance is all about numbers, so how well do LLMs actually handle math?
This is another area where LLMs can be surprisingly inconsistent. Even the most advanced models can struggle with math that's essential for finance, like calculating portfolio variance, for example. And they can get confused by different ways of phrasing the same math problem. What's really concerning is that sometimes they get the right answer, but through faulty reasoning. That makes it hard to trust their analysis. There's been research specifically focused on testing their math skills, and the results show that they're not perfect.
So even if the final number looks right, the process they used to get there might be wrong. And in finance, accuracy is everything. Finally, there's the challenge of evaluation. How do we even know if these LLMs are doing a good job, especially given the whole hallucination problem?
That's a critical question. Because they can produce wrong or nonsensical output, evaluating them often requires human oversight. We need people to check their work, basically. There's research into automated evaluation methods, but even those need to be validated by humans. And the fact that LLMs are constantly being updated and changed makes it even harder to come up with reliable benchmarks. Plus, a lot of the research on evaluation has focused on tasks with clear right or wrong answers. But finance, it's often more nuanced than that. It's not always black and white.
So we're still figuring out the best way to judge these tools in the complex world of finance.
Exactly. We need better ways to evaluate their reasoning abilities and catch those errors, both factual and logical. That's a really important area of research.
Well, this has been an incredible deep dive. LLMs clearly have huge potential in finance. They can analyze complex text, develop trading strategies, improve risk modeling.
And they can do it at a scale and speed we've never seen before. They're opening up new possibilities for understanding and navigating the financial world.
But we also need to be careful, right? We need to understand how they work, but we also need to be aware of their limitations, like those hallucinations and the math issues. And we can't forget about the evaluation problem. We need to be sure they're doing a good job.
Absolutely. It's about embracing the opportunities, but also being realistic about the risks.
So here's something to think about. As LLMs get even more powerful, how do you think this balance between their potential and their limitations will shape the future of finance? Will we see them everywhere, or will we need to be more cautious and use them in specific areas? It's something we all need to consider as we see more and more of these AI-driven tools in the financial world.